right. Welcome back to Financial Clarity for Doctors. I'm Corey Janoff, joined as always by Rachelle Vanderzanden.
Hello.
And it's been about 4 years since we last covered college savings in depth on this podcast. So we thought it would be a good topic to revisit. Um, and as with everything in financial planning, the quote unquote right way to plan for college will depend on your circumstances and objectives. Do you want to pay for your kids to go to college at all? Maybe not. Maybe. If so, how much and what type of school do you want to pay for? If you don't want to pay for it, but you still think your kids might want to go to college, how can your kids pay for it? Um, what a lot goes into college savings, or planning for college because there's so many variables and unknowns, and the range of costs is so drastic. 2 year versus 4 year versus 5 year, maybe. Or if you go to grad school, you're going to pay for that too. You're going to pay all 8 years of higher education for the kids. Public versus private, community versus whatever. So it can really vary drastically. But first let's dive into some current costs for college by various school type, and then we'll dive into some ways to actually pay for those costs.
Yeah. A lot of times when we start talking with clients about this, we use like a 4-year public in-state college as like an average number because those numbers can vary so dramatically. And that one is somewhat similar from state to state, although it can still vary dramatically. But the number that we use often is around $30,000 to $35,000 a year, even for public in-state tuition, room, board, housing, like all of the extras too. But still, like that's a huge number. And it's more than I think a lot of people think because like education costs have increased since you were in school, since we were in school. It's increased a lot. So, I mean, that doesn't include some of the extras that you may be willing to help your kids out with, whether they want to go to like a football game once in a while, a party. Corey wrote beer here. Not appropriate, Corey. Come on now.
Beer money
But
for college,
yeah,
it's like very
a
appropriate.
given.
Unless you're at BYU, but
A lot of
um,
college students aren't even old enough to drink yet. Good grief.
right. You didn't go to any
Anyway,
parties as a freshman where
you can tell I'm such a prude, you guys. So terrible. Okay, anyway, moving on. The average out of state public school cost is closer to like $50,000 per year. Average private school is about $60,000 per year. And because that can vary dramatically, I mean, you can just go to Google and be like the total cost of attendance for blank college, and they will list everything for like the 2024-2025 school year. And it will break it down by like tuition, housing, and like meal plan, books and fees and all that kind of stuff. And you can see like detailed information on all of these things. Some examples for you, like with private schooling, Stanford and Cornell cost an estimated $93,000 for like the 2024-2025 school year. That's huge. That's almost $100,000 for 1 year of school. There are other private colleges though that cost a lot. So Voorhees, is that how you say it, Corey? Do you think Voorhees?
Voorhees, I assume that's how it's pronounced.
Yeah, Voorhees University in Virginia, like only cost like $20,000 for this past school year. So that's dramatically
It's
different. It
private
probably
school.
has, yeah, it probably has a lot of like private funding, like just, things like that that help to make that education cost a bit less. There are some public examples as well. If you are in state and paying in state tuition, the University of California system is like $42,000 per year. So more than that average of 30 to 35 that we're talking about. University of Virginia is about $40,000 per year. University of Wyoming is like $26,000 per year, so a little bit less than average. And then Texas A&M is only like $16,000 all in. So it can vary a lot just depending what state you live in. So that's something that you can look into even when your kids are little. If you expect to kind of be in the state that you're in currently, you can use that as your number. Like Michigan, maybe it's like $35,000 per year. So lots of different things that we can think about. But it does make it very challenging to plan. If we really don't know even what college costs right now, how are we supposed to know what college costs in 10, 15, 18, 20 years? Like it's really, really unpredictable. So we just do our best when we're thinking about college savings.
Yeah, and even within the same state, the public schools can vary. I think the California number we quoted was for Berkeley and UCLA, higher cost of living areas, a little bit more prominent schools. But if you go to like the Cal State schools and some of the less populated cities, they're going to be less expensive. So again, just do some Googling, see what schools cost. It's all out there on the internet, very easy to find. And you can kind of get an idea of what type of school you may want to pay for, or depending on where your kids are at in their education. If they're getting into high school, they might have an idea of where they might want to go, and you could start. I mean, it's kind of late to start planning if they're in high school, but at least you can get an idea of what that tab might be costing you out of pocket if that's part of the how you're going to pay for it.
Yeah, and you probably already have an existing plan, so maybe that's just a good opportunity to tweak it. Like let's make some adjustments here. I guess the other thing about like some of the more expensive schools and things like that is it's pretty unlikely that any of your kids are going to qualify for like need-based scholarships and aid, but merit scholarships and things like that absolutely can be on the table. So, make sure your kids are fighting as hard as possible for those that's based on their abilities.
Study hard, dribble the basketball, and do whatever they can to stand out and
Swinging
be
the
a
golf club, I hear,
yes,
yes, female golf scholarships are apparently one of like the least utilized ones. So get those girls golfing.
absolutely. Yeah, for women, it's definitely there are more sports where you can get scholarships for. Thanks to Title IX, football takes up like half of the scholarships on the men's side, but they have to have an equal number of scholarships on the women's side. So there's generally more women's sports at most colleges, especially if the college has a football team. There's going to be same number of athletes, but less number of sports available. So, you got college, you got volleyball, you got field hockey, you got soccer, etc. A lot of opportunities for the athletic women to get college paid for. Um, but obviously there's merit based as well. So get good grades, etc.
Mhm.
All right. How do we want to help pay for college? First, we already talked about discuss with your partner and find out, assuming you have a partner, and find out how much support you want to provide. That can be a fun marital discussion because not all spouses are on the same page when it comes to how much they want to pay for. We have these conversations frequently and are take off the financial hat and put on the therapist hat in our meetings. Because
Love
we,
it.
yep. But come to some consensus on how much college we want to try and pay for, public versus private, all versus some, etc., and get some goals established. And then from there, it's easy for us to work backwards. All right, here's what the cost is anticipated to be. Here's how much we need to save along the way to get there. That's the easy part. The hard part is figuring out how much we want to try and pay for, and then just trying to take a wild guess on, all right, which one of these schools is our kid actually going to want to go to, let alone get accepted into. Um, so if you want to help pay for college, which is presumably what, if you're still listening to this episode,
If
you're,
you even turned it on in the first
yeah,
place. Yeah.
then so we're assuming most of you listening want to pay at least some of your kids' college costs. And saving ahead of time is usually the recommended strategy. The sooner the better, because the less you'll ultimately have to save in total, the sooner you start. And hopefully we can invest that money and it'll grow on average at a higher rate than inflation. No guarantees. Some years it'll be positive, some years it'll be negative, just like your retirement account. It's going to be invested basically the same way. So there's going to be ups and downs. Um, that growth, and we'll get into different types of accounts we can save into, but that growth is potentially tax deferred. Like if you're using a 529 account, you'll get tax deferred growth, which is great. Um, the more you save early on, the more time it has to grow and ultimately potentially have a larger balance to use to pay for college. Now, we don't want to oversave necessarily for college unless we're doing it in a flexible account that we could use for ourselves, because there are penalties if you're using the college savings accounts and it's not used for education, which we'll get into in a minute. potentially can get family members to chip in, for
Lots
birthdays,
of times
holidays,
grandparents want
etc.
to.
Yeah, we have some clients whose parents are pretty much fully funding the grandkids' college. It's like, hey, we've saved up, we're retired, we got money, we're gonna give you 20 grand a year to throw into the kids' college fund. It's like, all right.
Yeah. If there are any estate tax implications for your parents, this can actually be a great way to pass on some wealth without there being like gift tax issues. So we'll talk about the 529 account in a second, but they can put a big chunk of money in there without having to like have it count towards their estate tax exclusion. So that can be pretty powerful.
Yeah, so if your parents have some money and they're planning on leaving it to you and potentially your children when they pass away, it could be a conversation to have them start gifting some of that money now. If you can gift, any individual can gift another individual this year when we're recording this up to $18,000. So if it's a married couple, they could gift $36,000 to your child. If you have multiple children, you give 36 per child. If you're included in that, they could gift you and your spouse 36. So like you could do 36 times three, if you have you, your spouse, and your child, is how much they could, in theory, give to you without having to have it count against their lifetime exemption for estate tax purposes. So it can be a good way to start gradually siphoning money out of their estate and into the ultimate recipient's hands and mitigate the long-term tax implications of it.
Yep.
Math,
I think the one other thing is that with the 529 plan, you can also front load it and you can do like up to 5 years of your gift tax exemption. So that 36,000 per parent or per grandparent could potentially be 36 times 5. Like that's so much money. Yeah.
for sure. So speaking of 529 plans, that's probably the most common account that we like to use for college savings. It's essentially like a Roth IRA for college, or I should say education, because they've expanded it a little bit since it was originally created. Pretty much any type of higher education, college, trade school, vocational school. You can even use up to 10,000 a year now for K through 12 tuition. It's not really what they were designed for, but you definitely can use it for that. And it could be useful if you know we're going to send our kid to private high school in 14, 15 years. Um, okay, we could start saving up and plan to use 10,000 of that 529 money and get the tax deferred growth along the way. Now, in order to use money that's in a 529 plan for education, it must be a qualified expense. So tuition, room, meal plan, the books, basically everything you see on the school's website for that total cost of attendance. I don't believe you can use it for a car,
Or
or
transportation in general, airplane tickets,
yeah,
things like that. Yeah.
no football tickets or beer money.
Nope.
So, but the bulk of the cost to attend, all the necessary costs associated with attending college, um, you should be able to use it for that. Now, contributions to a 529 plan in some states are tax deductible at the state level. So you just check with whatever state you live in, and you can find out if you can deduct it from your state income for taxes and how much. Usually there's a limit on how much you can deduct. Some states don't have a limit, but most have a limit on how much they'll allow you to deduct. Um, if you don't use it for college, though, and you withdraw money, you pay income taxes on the investment earnings plus a 10% penalty. So it's definitely not ideal to if we don't need the money for college or if we oversave. But there are some provisions that allow you to still get money out or shuffle the money around. So there's a relatively recent provision they implemented that allows you to use up to $35,000 within a 529 account to fund the beneficiary's Roth IRA. Um, Now you can only fund an IRA up to the annual IRA limit. So with today's numbers, $7,000 is the limit. It would take you 5 years of funding it to utilize that full 35,000. But the cool thing about that is it doesn't the income restriction on Roth IRA eligibility doesn't apply. So your kid, even if they're making a good income fresh out of college, which is unlikely, you got to pay your dues early on. But if they're above that income threshold, maybe they're a programmer, a software engineer for Google or something, and they're making 250. But um, but yeah, they can fund their Roth IRA with the excess 529 money. Now there's a few, stipulations like the account has to be in existence for at least 15 years and a few other caveats. But it's a nice way to, if we did oversave a little bit, we can get some of that money out. But that's yeah, probably the biggest applicable scenario where
I think it's the
oversaving is
coolest
okay.
one. That's for sure.
Yeah,
That's pretty neat. I mean, you basically take money from an account that's been allowed to grow tax-free while you were saving into it, move it into another account where it can grow tax-free until they're retired, and they never pay taxes on any of that growth. That is super cool. Personally, I think so.
agree.
You don't really, yeah, you don't want to overfund it too much though, because in reality, when we're thinking about these big, big numbers of total educational expenses, 35,000 is not a lot, so it's easy to overfund it by even more than that. There are some other ways you can potentially get money out of a 529 account. So if you overfund it and you have more than one child, you can change the beneficiary from one related beneficiary to another. So you can roll it to your second child's plan. You could roll it to a grandkid like down the road. Lots of different ways to do that. So, and that doesn't have any tax implications as long as that new beneficiary now uses it for educational expenses.
You'd use it for
Um,
yourself. Like I've joked when I
yeah,
retire, I want to go to culinary school selfishly just to make cooler meals for myself. But um
because you enjoy it, maybe.
yeah, and yeah, I enjoy making food. So
There we go.
that could be a an option if you want to pursue another degree or educational opportunity.
Yep.
Um, but yeah, we definitely
One
don't
other
want to.
thing,
Or go ahead,
one
Rachelle.
other thing, Corey, is that when they get a scholarship, you can also potentially take out the dollar amount that they receive as a scholarship, and you do pay taxes on that investment growth, but you don't pay the penalty tax. So it's not like the best case scenario, but it's not terrible. You made money and you're paying taxes on the money that you made. End of story. But
For sure. Yeah, we,
yeah.
we definitely don't want to grossly overfund the 529s. So usually we'll advise people, let's start with the 529 because you get more time growing and tax deferred is ideal. But then once it looks like we have the equivalent of maybe the in-state public school level accounted for, say you want to pay for all 4 years, any school in the country. So we're saving for Harvard, but if they only go to the state school, that's going to be like a third of the cost. So maybe once we have the equivalent of the state school accounted for, that's where we transition our savings to something more flexible, like a brokerage account or a custodial account, which we'll talk about here in a minute.
Yep. There's one other account that you can use that's called a Coverdell ESA or Education Savings Account, and that it's not something we talk about a lot because you just can't get a lot of money into it. So it's a low contribution limit of $2,000 per year, and it also is limited to people who make below a certain dollar amount. So most people make too much money to even contribute to it. So it's just not something that comes up very frequently for our clients. Yeah.
Yep.
But investment accounts are cool. So the other way that you can switch to saving in a more flexible way for your children is either to invest in a brokerage account that's like a custodial account, which means you're in control of the money now, but they will be in control of the money once they reach the age of majority. Or you can even just save additional money into your own brokerage account, knowing that you will maintain control of that money. Like it's your money, but maybe we're earmarking some of it specifically for them to be able to use for college. And it really just depends on what your goals are. Do you want this to be money for them no matter what? Do you want to be able to maintain control of that money and it's your money, but you will give them as much as they need? And there are also some tax implications. So, Corey, I think you probably know the differences a little bit better than me, but basically in the account that's in their name, the taxes are potentially a little bit lower on those capital gains. Whereas the taxes of the account in your name is going to be just the same as your capital gains tax rate.
Yeah, you could probably Google it, but I want to say like the first 2000 or so
Yeah,
of
it's a pretty
dividends
small
and
dollar
capital
amount.
gains is taxed at the child's tax rate, which would basically be zero, unless they're earning decent income. And then after that, it's taxed at the parents' rate. The uh the other benefit of the custodial account is it's the kid's account. So if like you get sued or have to default on debts or whatever the case may be, that money is not your money. It's the kid's money. So they can't really go after that money. The flip side of that is it's the kids' money. When they turn 18, it's theirs. They can do what they want with it. Now you don't have to tell them that you set up an account for them and they own
Do
it
you not?
completely. Well, there's no rule that says you have to disclose to your 5-year-old that you have an investment account for them.
Oh, I
But
meant when they're 18
oh,
though.
yes, when they're
Yes.
18, you have to sign that over to the kid. So they will eventually get wind that they have some money available because they're gonna have to sign some forms to make it their own. And that's one where everyone's different. Everyone has different thoughts, opinions, but some parents uh like the idea of setting up an account for their kid in their kid's name, earmarked for their kid. Others are like, I don't know if I trust my kid just yet. What if
They're
they,
5. I don't know what they're going to be
yeah,
like when they're 18.
yeah, are they, which crowd are they hanging out with? So yeah, pros and cons to each there. But yeah, asset protection and sort of taxes are an argument for doing the custodial account, whereas control is the argument for just doing it in your own brokerage account. Or maybe you set up a separate brokerage account in your name that we earmark for the kids. So we aren't commingling our retirement money with the kids' money. And we set that brokerage account up for the kids, say this is designed for college, and if we don't need it for college, we can use it for a wedding or home down payment or a car, or maybe we want to save for all of the above and really get our kids set up for success once they're adults. And but it's still your money and you control it and have a say of how and when it's being utilized, as long as you're alive, I suppose. But that's where estate planning and setting up a trust and things like that could come into play, so you can still control the money after you're gone.
hmm I do have clients who have custodial accounts like from their parents. And I think the reality is that even though it's your money and you kind of know it's your money, you don't really feel like it's your money. And that doesn't necessarily have to be the case for every 18-year-old. Like some 18-year-olds may very well be like, okay, this is my money now. I get to do what I want with it. But I think for a lot of people, it just doesn't really feel like that. You're like, okay, sure, my parents gave me this money, but it seemed like they wanted me to do this with it. And maybe that's what I'm gonna do. Like, yeah,
Yeah. And I
who
mean,
knows?
our clients, like all of you listening, you're all very responsible
They're the
humans.
high achievers.
Yeah. And, most likely those genes will pass on to your kids, but it's, you never know. Like you all, I'm sure, have friends whose children maybe didn't turn out the way that their parents wanted them to. And I'm sure you had friends too that kind of didn't go the right direction once they got to high school and they're paying for it now. So yeah, you never know.
Very true. So one other way we can pay for college is through student loans. I think a lot of you know that already. And maybe we don't have enough to pay for college in full. Maybe your kids decide that they want to do additional schooling beyond that 4 years that you plan for, whatever the scenario is. If you want, you can help your kids pay off the student loans over time. We have lots of clients who've experienced that as well, where their parents have just given them a chunk of money. Just at that time, you're going to make sure that you want to assess the current student loan environment and make sure that makes sense. If there's still something like public service loan forgiveness around, maybe we don't want to give them a ton of money to specifically go towards their student loans. So just like if you had student loans yourself, just like you evaluated all of those options and all of those ways to get rid of them yourself, you can help your kids do the same thing.
For sure. Yeah, plenty of parents help their kids pay off student loans. And I mean, yeah, if great way to pay for college if you haven't saved up ahead of time. You say, hey, I can't afford to cut a check for $250,000 and pay for your college here, but I can afford to pay 2, 3 grand a month on your student loans once you graduate. And let's do that instead. I don't know, to each their own. Let's see, other strategies. There's the military route, free education, but you owe service to the military. So pros and cons there. Community college for starters, lower costs, and then you could transfer into a traditional university to graduate with the degree with the fancy name on it. Brings the cost down considerably for those first couple years, and then you pay the larger costs the last couple years, but essentially you get the same degree for half the cost. So that could be a decent strategy as well. But what other thoughts do you have, Rochelle?
I mean, obviously, just like with everything we talk about, establish your goals first and then work from there to design a strategy that makes sense for you. Just, how important is paying for college? Where does it rank on my list of financial goals? Is it more important than retirement? If so, and you're like willing to work longer, cool. If retirement is a high priority and you want to help your kids in like some way, shape, or form, make sure you're hitting your retirement goals and then do like a little, like some of what's left towards the college savings goals. It's just like put it on a list. Make sure that you understand really what matters to you the most. And if you and your partner disagree, like hopefully we can find some sort of compromise. Financial aid, like any sort of need-based aid, is unlikely for kids of doctors. So if you're one of our doctor clients and you're listening to this and you're a high income earner or you're a different kind of high income earner, probably not going to qualify for a lot of aid. So let's not bank on that. It's not going to happen. Although there are more states that are doing very broad assistance at like a basic level. So not like a ton, but like Oregon, for example, I think has worked towards free like community college for kids. So if you want to take that like community college route for the first couple years, awesome. That could potentially be paid for even more so, or not just cheap, but free. And then have them move into a university. That can be a strategy as well. The sooner you start saving and planning, just like with any of your goals, the sooner you do it, the less you're going to need to save in the long run, as long as investment returns are kind of what we expect them to be. So when we are doing college savings projections, we often estimate like a 4% tuition inflation rate, which would mean that tuition is likely to double 18 years from now. So we're talking about these numbers and they seem huge. Just think in 18 years, it could be twice that. And maybe your wages have increased as well, but tuition has on average been increasing at a higher or like a faster clip than wages and things like that. So it has become more expensive over time. So with that being said, if we're doing that like public school, in-state tuition, and we're assuming 4% inflation, that means you might need to target like $600 a month from the time you have a tiny, tiny little baby until they start school. So that's quite a bit. I think it's more than most people expect. And if you wait until they're age 8, it's going to be double that. So the sooner you get started, the better. Just like with everything.
Yep. And yeah, you can speculate on the future of higher education in America and go down all sorts of rabbit holes and whatnot. But, and I think it was, what was it, about a year ago? One of the med schools in New York, or maybe was it NYU or Albert
NYU.
Einstein? Yeah, they
It
announced
was
free
NYU.
tuition for everyone. Obviously, you
Hmm.
have to get accepted into it,
Yeah,
but thanks to some generous donations, they're able to not charge students med school tuition. So it'd be curious to see. I'm sure there will be some schools in the future that might roll out similar programs to entice applicants and but there might be consolidation of schools. Like if tuition keeps rising at the rate it's rising, it's gonna eventually become cost prohibitive for too many people, and not as many people will be going to college, and there'll be a breaking point where either colleges decrease enrollment or I don't know. You can speculate all you want. Like the brand names, well, Harvard can charge as much as they want for as long as they want, and people will still attend. I mean, people were paying 500 grand just to get their kid into Harvard on top of having to pay for the tuition. So it's illegal to bribe your way into college, but people are still doing it. It's so yeah, the brand names will be fine. Curious about the less prominent schools, what's going to happen to them if the trajectory keeps going, but we'll likely see some changes in higher education over time and we'll have to make adjustments along the way. So like all things with financial planning, it's not a set it and forget it type of deal. It's worth revisiting periodically and make sure you're still on track to reach the objectives and make any necessary adjustments along the way.
absolutely. Thank you for listening, everyone. If you do have any questions, you can always, email us, look at our website, do all the things.
See you next time.